Hey Bowtie Nation, Joseph Hogg here. And renting or buying, housing is out of control. The average rent has surged 41% since 2020, adding over $1,000 a month in costs. Housing affordability is the worst it's been on record, with families putting almost half their budgets up just for a roof over their head. And let's be honest here, folks, no politician, no central bank is going to fix this. According to data from Bankrate, wages are just not keeping up. But here's the real question you need to be asking. What if your investments paid the rent for you? Not someday, not after 30 years of investing, but right now, using income ETFs that could potentially spin off enough monthly cash flow to cover one of your biggest expenses. That's what I want to show you using 5 of my favorite ETFs to watch right now. Let's get started with the first of those ETFs, and I'm going to show you how to find these later. But first up, the Yield Max Target 12 Big 50 Income ETF, ticker Big Y. The fund aims for a 12% annualized distribution, which means you have the potential to collect about 12% a year paid out on a monthly basis while also seeking that capital appreciation. The fund uses an option strategy, writing options to generate that income. But unlike a lot of the other high-yield ETFs using this, the Biggie uses 2 guides to try to avoid the drop in the portfolio value. First, by focusing on the large-cap growth companies. The strategy attempts to follow the market higher in an effort to produce profits that can help cover those distributions. Also, though, instead of aiming for the kind of income that all but guarantees a NAV decline, the Biggie targets a smart 12% a year. Now, that's how it tries to help you with that income to pay the bills and still watches out for the NAV in the future. At its core are some of the largest, most liquid companies in the U.S. markets. Names like Apple, Nvidia, Microsoft, and Amazon. These stocks help give the Biggie broad exposure to the major market drivers and a base for its option strategy. Looking at a chart of the Big 50 Income ETF over the last year, not only has it produced that 12% income, but also tracked closely with the return on the S&P 500 market index, up 25% over the last year, but paying a paltry 1% dividend. So, the Biggie's goal is for you to have your income cake and eat it too. The Target 12 Big 50 ETF has met its target 12% income and on a total return basis has beaten the S&P 500 index, that 12% income plus nearly 8% price return over the last year. Now, I like the Big 50 ETF for that large cap growth stock appeal and its appeal to anyone looking for a targeted 12% income, but it still wants the potential in the stocks making the headlines and leading the market. But here, I've got 4 more ETFs with targeted incomes to highlight. But first, we should look at a common pitfall that is going to trip up a lot of investors along the way. You see, folks, investors trying to pay their bills with their dividends often get burned because they chase the stocks with the highest dividends. But then the nasty starts to happen. That income looks great. Hell, you're sipping Mai Tais in a hammock before your boss even knows you're gone. But when you check your account value, it just about choke on the little umbrella. That's because on a lot of these, the stock price falls month after month until you realize you didn't earn income. You just got your money back slowly and painfully. That's called NAV decline, and you're going to want to fix it before you truly use your stocks to pay your bills. Now, NAV stands for net asset value. That's the value of the stocks or the investments held by an ETF. NAV decline happens when the ETF pays those distributions, the underlying stock dividends, but can't fully support the payout by its own income. Now that means the fund has to sell some of its assets, which in turn causes the share price to fall. Think of it like this. If you have an account earning 5% interest, but you take out 10% every month, it's not going to be long before there's nothing left. Unfortunately, there is a fix to this kind of NAV decline, and I'm going to walk you through 2 solutions next. But first, I want to highlight another of my favorite ETFs for this income, the Target 12 Real Estate Income ETF, the RNTY, which uses the same option strategy on a basket of real estate stocks. You out there in the nation know I got my start as a real estate analyst, so the asset's always going to have a special place in my heart. Not only can real estate serve as a hedge on inflation and income producer, but can also help soften the impact of the ups and downs of the stock market on a portfolio. The RNTY holds a portfolio of 15 to 30 U.S. real estate companies, including real estate investment trusts, those REITs, and other real estate stocks, then uses an option strategy for that 12% annual income target. And while real estate stocks have underperformed over the last 5 years on those higher interest rates, Here we see real estate stocks in the S&P 500 index have produced less than a 1% return versus the 18% on the broader S&P 500 index. It's still my favorite sector right now for value. That's because as interest rates come back down, I believe real estate is primed to unlock value. And that could mean both strong price upside and the potential for that 12% targeted income yield from this fund. Back to that problem of that NAV decline, and your first solution to that problem is reinvesting that part of the income distribution, that is return of capital or ROC. Now remember, if the ETF didn't cover all its distribution with its own profits, then it uses some of those assets to cover the gap. That portion is basically just a portion of your original investment returned to you, a return of capital. Now, return of capital isn't necessarily a bad thing. You're getting part of your investment back, so you're not really losing that money, and it's not treated as a current taxable income. Instead, it reduces your cost basis in the ETF, which means you receive cash today, while potentially deferring taxes until the shares are sold. So, by reinvesting some of your distribution back into the ETF, that means even if the share price falls, you're going to keep your total portfolio value from falling quite as much and still keep earning that potential income. But I know that solution can be confusing, and I think there's a better way to fix this NAV decline problem without reinvesting the ROC portion of that distribution income. So strategy number 2 here is just not chasing that yield and sacrificing growth, but to balance it. Finding the ETFs that meet your income needs, but don't deplete your portfolio with that return of capital. Now, I'm going to show you a special tool to do this later. But it's all about balance here, getting that income you need but not crushing your portfolio's future. When you're looking for those high-yield ETFs, go to a 1-year or a longer chart of the price and compare what the ETF has done in the past. You can compare your target ETF here against those benchmarks, like the S&P 500 and the high-yield indexes, that there's almost always going to be some underperformance against that low-yield index like the S&P 500. But if it keeps up and holds its value, an NAV decline might not be the issue that you see in some of these other funds. And I'll share that free online tool to help you look for those ETFs next. But if you're looking for upside appreciation alongside that income, check out the Target 12 Semiconductor Option Income Fund, ticker SOXY. Not only does the SOXY seek current income at a targeted level of 12% annually, it's also pursuing that capital appreciation. Here we see that same total return comparison we saw with the BIGY. The price and the income return on the Semiconductor Option Income ETF in white with its 80% plus total return over the last year. A double-digit distribution yield against the return on the broad S&P 500 market index. Now understand there is some volatility and concentration risk that comes with a little bit more risk here. This semiconductor ETF isn't as diversified across different types of companies as that Big 50 ETF. Now these are all companies in the same industry, those semiconductors, which can be highly cyclical, and that means there's going to be periods when the entire industry, every stock in this group is weighed down, and that's going to bear down on performance. And you can see that while the SOXY fund has outperformed with its very strong 28% return, the price has jumped around more than these other two income funds. The Big 50 ETF followed that volatility and the tariff madness of last year, but has leveled off since August. And the real estate fund has been the least volatile of all. With the semiconductor fund, you're going to get that higher growth potential, but be ready for higher ups and downs on the price as well. I'll share 2 more income ETFs with higher distributions next, but I want to thank YieldMax for sponsoring this video. Now, YieldMax isn't chasing meme-level income in its ETFs, instead building options income funds seeking to turn that volatility into regular periodic income. I wanted to highlight the Target 12 and Target 25 funds because their goal is to maintain that thoughtful balance between income generation and preserving the overall portfolio. It's easy to find the perfect ETF to fit your needs. From income-focused ETFs with a higher income to the growth and income funds like I'm highlighting in this video, you'll find single-stock ETFs that use a high volatility stocks like Tesla and Nvidia as reference stocks in an attempt to create even higher income using options with some upside potential. The Fund of Fund ETF seeks to give you exposure across multiple of YieldMax options, income ETFs, each linked to a share price of a specific company or an ETF. And my favorites here, the Target 12 and 25 funds, which look to balance that income with growth. Click through, and you'll be able to find all the information you need about a fund. YieldMax is completely transparent, showing you the distributions, return of capital, performance, and exactly what is in every fund. And back to our list for an even higher targeted income than those we've already looked at here. YieldMax has the NVDA Performance and Distribution Target 25 Fund, ticker NVIT. This is one of the newest funds in the YieldMax lineup, using a synthetic long exposure to the common stock of NVIDIA and using an option strategy against it to target a 25% annual distribution. And not only does the fund target a higher annual income rate, but it also pays it out on a weekly basis rather than monthly. Now understand here, you might not have that potential price appreciation that you could in the target 12 funds. If the ETF meets its 25% annualized target income percentage, then there's likely to be a little bit more NAV decline here. But the idea is that growth in NVIDIA, along with the potential higher options premiums, can help limit that effect. It's an aggressive income strategy, but in this current market, believe there's few stocks better to use as a reference asset than NVIDIA. But if there is a stock able to do that option strategy better on, it could be Tesla. And here, with the TSLA Performance and Distribution Target 25 ETF ticker test, this one uses that same synthetic long exposure to the common stock of Tesla with option strategy in an effort to produce that 25% income target. Also launched in November, not only had the shares paid out that 25% annualized target, but are also up 3% over the 2-month period and pays out a weekly schedule. Now, just like with the NVIT, it is a riskier strategy focusing on just one stock. So, you need to be bullish on the upside for Tesla if you're going to invest in this. If Musk can pull off his robo-taxi and then transition from cars to robots, though, I'd continue to be bullish on this stock. Click through the link to YieldMax in the description to help you fine-tune your ETF investing strategy with one of the funds in this video or with any of the YieldMax ETFs.